All right. Hello, everyone, and welcome back to the Petronerds podcast. This is episode 107. It might be episode 108, depending on what happens with the Fed tomorrow. But today is Tuesday, April 30th, 2024. And I am absolutely pumped because I have a fantastic guest to introduce you to. This is the Sam Shiverick, the CEO of Buckhorn Production. He is in Fort Worth. Obviously, we're doing this remotely. But Sam, welcome to the Petronerds podcast.
Thanks. It's great to be with you guys today.
Awesome. Awesome. Well, okay. So I'm going to do this. If you've listened to the podcast before, if you haven't, Sam, you really should. WTI, we're time stamping this as of right now. We've really come off some previous highs, but we are 81.91 by, I always say this is not a bad oil price. So if people are complaining, they shouldn't be. Brent is 87.90. We are looking at Henry Hub. We've moved up a smidgen, but we are still sitting at under $2 at $1.99 for Henry Hub. Dutch TTF is kind of getting pummeled. We're 883 for Dutch TTF. Just remember, it was only a couple years ago we were at $100 an MCF for Dutch TTF. The 10-year yield, though, and that's why the Fed stuff and the macro, which I think Sam does want to touch upon, which will be fun. 10-year yield is at 4.64% or 4.674% right now. That is putting the 30-year mortgage at 7.66%. I have spent I like to start my days now with nice weather in Denver with listening to the Bloomberg surveillance podcast and doing like fast speed walks with the dog. It is mortgage rates this high are pretty insane. And there's a lot going on in the market. Tomorrow we have the Fed decision, and there's going to be a lot going on there. But today, we can talk about the macro. We can talk about anything you want to, Sam. But I want to make sure, in this podcast and for listeners that we talk about your assets, where you guys are at. You guys are production and pump jack company, hence the pump jack earrings today. I love
Love
I
it.
love the production side of the business. It's a really great business model. So, and it's very different from, I think, obviously an E&P company who's drilling, completing wells. So I want to just address that. And of course, I want to get into how you see the market differently than your peers. And we're definitely going to talk about ESG and methane and all that stuff. Not going to promise the listeners we will agree, but that's perfectly okay. So, Sam, where do you want to start?
Awesome. Well, I can just kind of give you a background of how we got started and a little bit how I got into it. So, originally from New York, just outside the city, went to the University of Colorado to study geology. I was a geologist for WPX Energy in Denver and Tulsa, and then worked for Marathon Oil for 3 years as an exploration manager. Going up, taking the entrepreneurial route is something I always wanted to do. And when COVID happened, I think all of us had some sort of COVID moment. I remember I was with my family on vacation and I saw a Marathon stock price go down about 70% or more. And when oil price went to minus $38, and at that point, I was kind of deciding, should I leave oil and gas? I've been doing it for about 8 years at that point. I really loved it, and or should I double down and go off my own? Was now the right time to do it. I felt like I had just enough experience to do it, just enough of a network to do it, and I guess the willingness to jump into the deep end. I was super lucky to partner with a guy named Jeff Harvard out of Roswell. Jeff has been in the business for about 40 years, based in Southeast New Mexico. Really smart engineer with great deal chops and just a great person overall. And so we partnered up and we bought about 220 wells um, from a large public company. That deal, we signed the PSA December of 2020. Oil was $40, and we closed on the deal in April of 2021. So we just hit our 3-year anniversary as a company, and they, in every meaning of the word, they were shipper wells. It was about 220 wells, including 12 SWDs, and it was kind of right in the heart of Lee and Eddy County on the county line, and it was doing about 1,000 barrels of oil a day gross, between all 220 wells. Um, we quickly assembled a team of rock stars. I was based in Houston at the time, Jefferson Roswell, and we added teammates in Denver, Artesia, and Houston. I was working remotely at the time for Marathon because it was COVID, and we're a big believer at Buckhorn that bear the pain, do it the hard way first, and don't kind of come out spending a bunch of money on stuff you don't need. So we didn't have office space, we didn't have office furniture, we didn't have admins, we didn't have any of that. It was very much a humble beginning of kind of doing everything ourselves and hiring the best people we could find in our network, regardless of where they lived. And so that was kind of the easy way to do it. And that's just what was natural at the time. We quickly were able to increase production on those wells due to kind of blocking and tackling and just spending the time and energy on that base production. The exciting thing we see in the PDP world is that these assets, when they were drilled 15 years ago, let's say, by the large public company, they were drilled with all the best technologies at the time, gold-plated facilities, everything like that. And then fast forward 10 or 15 years later, what you're seeing is these assets, they're really high quality assets, but they're not getting a lot of human touch. They're kind of rolled up into a legacy portfolio within a large public company. And a lot of the new talent wants to focus on the new drills because that's where the dollars are being spent. That's kind of the sexy place to be at a company. And so what happens is these assets kind of get neglected, and you see it in every industry, and particularly in oil and gas. There's so much; it's so capital intensive as a business that there's so much time and energy from management down focusing on where the dollars are being spent, and that's in the drill bit. And so everything beyond that can get neglected. And so, oil being $40 when we started, we knew we weren't going to be drilling wells, and Jeff and I knew whatever we were going to do, we were going to put a whole bunch of our own money into, and so buying production was kind of the only option at the time. My background being exploration and geology and drilling, I love drilling, but a lot of the wells that are drilled, in the shale era, don't always pan out. If you kind of blend it up together, when you think about the full F&D cost between the leasehold, drilling completions, and payback. So what we've been able to see is buying production. You got to buy it right, and we've been very fortunate and lucky with timing. But because there is some meat on the bone with this kind of neglect we're talking about, you can actually generate drilling like IRRs without taking on the same amount of risk, and without having the capital intensity of drilling and completing new wells. So we love the model. We by no means created this model. People have been doing this for a very long time, but we're really happy with how we're executing on it. The team we have is incredible. Those guys really get all the credit for growing production and fighting off decline. And we think there's probably a million wells like this that fit this criteria. We've taken it further. We've hired an absolute stud from Houston with data analytics engineering background, and we're actually writing code to identify wells that have that neglect decline portfolio, the decline profile. It says, okay, this well was producing at a steady state, and then COVID happened. Company X shut it in, and then they quickly shut it in, but they didn't quickly bring it back online when oil prices recovered. So you can, or a private equity company bought something from Chevron to prove up the western side of the Midland Basin, and the PDP assets that came with that were not a core focus. Private equity companies not going to hit a 3x by focusing on neglected production. They're going to do that with their cost of capital. They're going to do that by proving up undrilled leasehold with longer laterals, or kind of extending the core, if you will, and the producing assets that come with that get neglected. And you can actually timestamp those series and see the production curve. All things being equal, a reservoir drawdown is a very predictable flow profile. But when humans start getting involved and you start delaying capex, or you don't do an artificial lift change when you're ready, you can see that over time in the production profile. So we're now targeting wells that fit that criteria. So that's a little bit of a background on kind of how we view the world and the assets we operate today. We did another deal last year in the same company, it also in southeast New Mexico, the New Mexico side of the Delaware Basin. And so today we operate about 250 wells, and we produce about 2,000 barrels a day.
Okay, 2000. That's where I was going to ask. So
Yeah,
A lot of stuff to unpack there.
yeah,
It doesn't quite characterize how you view the world, but one, it's a great model. I completely agree with something I want to do in 2020. Certainly didn't know have the money or know the people, but would still love to be a behemoth of stripper well production. And I think you're well, it's great that you're writing code. I don't think you actually need code to go through the production in the U.S. and know that what's targetable. I think you've characterized really well. And from a business model, like, I mean, listeners know that I love production. I love the pump check side of the business. And I do think it's completely underloved and underappreciated. Probably, a little more is coming back to that, especially as companies are slower on the E&P side, right? They're not going as gangbusters. They're not spending nearly as much capex, so they have time to sort of slow everything down. And if you are not maximizing your wells at $82 oil, I mean, you're really missing the boat. You should be doing that at every oil price, but you certainly should be maximizing everything. And too often, E&Ps, since the share revolution began, have been drill, baby, drill, but it's really about complete. And that as your point, that sexy piece of the business is everybody's on completions and they're fracking like crazy and they're going gangbusters. And we've had so many waves of this. And even I think even the posts or in the COVID wave, the completions weren't scaled back, right? They were actually pretty big because everybody wanted to go big or go home, and they needed to have that delivery returns to actually make sense for why they were spending money. And so I think there's a case to be made for no matter what, production gets pushed off the sidelines. And I grew up around it. I'm third generation oil and gas. My dad pumped oil wells, my grandfather pumped oil wells and gas wells. But I mean, it takes that human touch. And so I think I hear a lot from businesses a ton on, how little people are in the field now and how everything can be done with automation. And I think it takes one or two people to really sort of have that human touch in the field, to be looking at these wells and thinking about it, and to take a human capital approach and taking that mentality on these wells. So I think it's a fantastic business model. And I know we've talked offline before. So you've now said that you've identified, whatever, a million wells. We know there's tons of stripper well production in the US,
yeah.
but you are primarily focused, which is brilliant. I mean, your well purchase just sounds incredible, of buying, 15-year-old shale well, unconventional wells in Lee and Eddy County, which again, that is kind of a newer business model in terms of, I think, going after production, production from the unconventional side. um are you guys slowly looking to expand? Are you expanding? Are you happy with, taking, this first chunk from 1,000 barrels a day, being able to bring that up, and, obviously creating these stellar returns and just being methodical, taking it slow? Or are you looking to bite off? And I mean, this kind of gets us into the oil price environment and how you view the economy and the macro. And this to me doesn't seem like the greatest opportunity to go in and buy a bunch of stuff at 80 something dollar oil. But that being said, that doesn't mean I'm right here, and there could be opportunities because people aren't thinking about it correctly.
Yeah, we are restless to grow. I mean, anyone who knows me and anyone who knows Buckhorn like knows that we are not. We don't really take anything slow. We're constantly challenging each other and looking for deals to grow. But price timing is a big part of it. We're fortunate with what we've done with our existing asset. Maybe a third to half of that was timing, and then two-thirds to half was building up the production base and not seeing any decline. But if you take away the timing, you could be, you'd rather be lucky than good, right? I mean,
Right.
it's so true in this industry. Luck is absolutely important, and you need it to succeed here. That being said, you don't really want to buy an oil asset at $80. Now, where the strip is, as we all know, I mean, your average price over the next 12 to 18 months is going to be, probably $72,
So are
right?
you
And
are you
so
hedging?
we hedge opportunistically. So if we take on a lot of debt for us, but relative to industry peers, it would not be considered a lot of debt. We would hedge.
Right.
If we see the momentum building, and oil runs or gas runs, we'll throw in some hedges. At this point, we have pretty much effectively no net debt, and we have no crude hedges or gas hedges in place today. We just rolled off some hedges in Q1. If oil runs up, we'll throw some hedges in. If we kind of like our cash flows and we like what we're seeing, or we're building up, right, getting ready for a new acquisition, we'll throw some hedges in. If we make a new acquisition, we will hedge that. We like to kind of take some of the cowboy out of it. And if you have a deal and you like the price and you like the returns you're going to get, throw some hedges in there, especially depending on the shape of the curve. I think one of the best hedges right now is a gas strip, because gas is in contango. So you can do a 3-year swap on the gas price, and get $3.30 tomorrow at your wellhead.
Yeah.
Okay.
So,
Whereas the front month, well, today it's up to $2, and we can talk about that. But like the front month last week
well,
was about a buck 70,
yep.
and
We
so
should. It
what?
was actually $1.64. We should talk. We will talk about gas, but I guess I mean, given exactly what you're producing, you're not taking E&P
Yeah,
risk. And a few weeks ago, and I'm not trying to criticize the model because it makes sense to be diversified, but there are times very recently you could have hedged to $80 strip for a year. If I'm producing a couple of that, like that sounds appealing, even if I'm even if I'm drilling completing, but those are really good. That's just like take it to the bank. Is that
yeah,
thinking just because you have a diversified approach, so you don't want to get it, you don't want to, it doesn't matter what oil prices are, you're going to keep that approach no matter what. So even when, you don't want to, I wouldn't advise doing that when things are lower, but at these levels, with the macro, with the volatility, with everything, that seems like, I would happily and will advise clients, like, at these levels, absolutely, if you're willing to take some risk off the table. But $80 oil, like, yes, does it go to 85 or 86? Yeah. Does it
yeah.
go down? Yes. So then it's just kind of getting greedy. So just curious how
No,
you're
for
thinking
sure.
about that.
We've hedged at this level. I mean, our average hedge price in Q1 was, I think, $82. So I mean, we like this level to
Yeah.
hedge.
Okay. That's
We're
what I
just
thought.
not hedging.
Yeah.
We're just not hedging today.
Okay.
And it doesn't mean we won't hedge tomorrow. But as far as growth, okay, let's talk about this a little bit. So, I mean, we kind of have a process where we identify wells we think are neglected, especially if it's kind of bolt on, you know, in proximity to our other assets, and then we go inbound to some of these big public companies, right? The whole name. I don't need to name them. Everyone on there that operates in our area, we're talking to, and that's a game. That's a sport. A lot of these, a handful of companies just will not transact, or they only do marketed deals, and that's fine. So you can only hit your head against the wall so much with those guys. Some of them are very responsive. They respond to your emails. They talk to you, and they're willing to get lunch or coffee. And it might take 2 years to get something done. That's fine. That's the sport that we signed up for. That is our game. That is the way we do business development. Others are very transactional, and from first outreach to a well list, with working interest and an LOS. I mean, you can make an offer and you could be negotiating it within 45 days, on a bilateral side. So that's great. And then the other thing is, like, you got to find that individual in that company, who has enough stroke and is willing to stick their head out for a $10 million deal, or even a $20 million deal. What we've seen is anything less than about $25 million, the companies are willing to sell without, going to a bank. The banker fees aren't really, the bank won't really make enough money on a fee. I mean, there are some middle market firms that do a great job, marketing those assets, but anything under $25 million, I think you can kind of get. But you got to be fair, and you got to be a good trade partner. The way we approach these deals is, all of the companies we've dealt with, we really want to make sure that we're a good trade partner. We take over these wells. We take care of the methane side, the operating side. We're fair in the PSA process. We close on time. We have the cash, so that we want to do deals with them for the next decade. And then as far as oil versus gas, we would love to buy a gas asset today, and it doesn't need to be in New Mexico. Um, and so, I think if you're growth minded and you have a pipeline of deal flow, and you have a process, and and you're always building that network. I think there's always something to buy. You just have to be able to execute in multiple basins, or multiple business models, or different commodity mixes.
Yep. And I
Um,
that diversify, and I love, like, and I love the nat gas side, to be able to think about that, because I don't think people are thinking creatively about stripper well production on the nat gas side, which does have material upside, and it's hard to in this $2 environment. But I want to back up a little bit, because you touched, that was
yeah,
a really nice color and great recap. But this touches on something we've talked about this a bit offline. I know that I've had folks on the podcast and impressed them on this, but I have been frustrated. growing up around production, knowing the business closely, I have been especially frustrated with the business on the ESG side, the E&P side, especially the publics, which they're cool in their jets right now. They're definitely slow in their roll on, pushing ESG. I believe the number one, the first company that actually started talking about net zero, ConocoPhillips, the first big independent, you can't even find it in their slide decks or their presentation, so they're not even mentioning it. That being said, companies like that, there's a myriad of companies that are big behemoths, right? And when you speak with them in the past few years, this whole ESG movement and the whole methane movement and everything has really pushed them to say, okay, firstly, everybody's a bull in oil. You're an oil company, you kind of have to be. So let's just hold that we're a bull in oil, which means you should be thinking strategically about all your production, all your assets. And secondly, all these big publicly traded companies are looking to either like actually plug and abandon these wells, or they're looking to hand them off to somebody else because they don't want the liabilities for some of these older wells and their answer or their explanation is, well, it's too expensive to capture the methane. It's too expensive to do all this stuff to hit not necessarily things that are required, but things that would be required, be a good steward, etc. I struggled with that. Okay. Certainly struggle with it because at the time when I was speaking with a lot of these companies, we weren't at $82 oil. And so if you're $82 oil, it seems prudent that if I have some wells that are producing 500 barrels a day, that I bet I could get some equipment and get these up to speed, and I could actually probably, if I focused on them a little bit, maybe increase their production. But I would love to get your perspective on that. We can talk about how you guys maybe think about that differently, being a smaller company, but what is it like from actually when we hear about bigger companies saying, I just want to offload and P&A these wells? And guys, I've said on the podcast before, but I think it's really serious. We're talking, if you start adding this up, you can just talk to a handful of big companies, it's 5, 10, 15, 20, 30,000 barrels a day that they're willing to plug because of this. So, are they right? Are they saying, yes, we cannot afford to put all this equipment on to capture the methane and get up to speed? Like newer wells, we know that it's pretty easy. You get all the new equipment, you got on the tank batteries, hatches and everything. It doesn't seem that hard to me to do this on older wells. Am I wrong?
Yeah, I mean, there's a lot to unpack there. I mean, so first of all, plugging wells has the price to plug wells has gone up big time. Like
Yes.
we just plugged 12 wells recently, and it was a lot more than we underwrote, and honestly, it was a lot more than we all thought it would be, and that's us. And I
Yeah,
can
I hear
promise you,
that a lot.
the big companies, it's costing them way more because of the overhead they have. So that is something to be aware of. As far as retrofitting facilities for methane, there's a lot. It's in the last couple of years, it's kind of been a moving target. And I tell you, like Buckhorn, our ethos on it is like we punch above our weight when it comes to methane. And I'll kind of shed some light into why. Um, Assets in New Mexico, Delaware trade at like almost half the price as that same asset, a PDP package in Midland County. Okay, there's two reasons, and we bid on both, and we were shocked how much the market was in Midland County or the Midland Basin versus Southeast New Mexico. And people, in Southeast New Mexico, there's really not much out there. I mean, you got Artesia, Carlsbad, Hobbs, Roswell, but those are all small towns, and the oil field is like an hour from those towns, at least where we are.
Right.
Whereas, you're 2.5 hours from Midland, and in Midland you could, live in the suburbs and pump 50 wells and come home for dinner. And so like it's just way more convenient. And then there's a whole regulatory side, which is kind of the root of your question. And so, we're buying assets at a discount to be New Mexico. Okay.
So
And
you're saying you're getting a significant discount largely because of the regulatory burdens because you're in New
yes,
Mexico.
I'm saying the assets we're bidding on we have very little competition because people don't want to be in New Mexico. And it could also be a function of how they're marketed, whatever. Like I'm not trying to invite other competitors,
No,
but
no, that's absolutely.
the point
No,
is,
that
it's
makes
just
a lot of sense.
less people want to be in New Mexico now. We're already there, and we have the regulatory infrastructure to continue to excel there. So to us, it's really a non-issue. But how do we do that? Okay, so we feel like because we're buying these assets for cheaper, we have to give some of that money back, and we're going to give some money back by like having punching way above our weight with methane. We do quarterly flyovers with Bridger out of Montana. They're fantastic. We've done, we have our own gun, our own methane gun, flare camera. Sorry, that's what it's called. We have a guy who works for us every day. His only job is to go around and do AVO and flare and shoot flare guns. And that stuff you didn't have to do a couple of years ago. Stuff you don't have to do in other states. Now it's elective. No one's really. We have
Right,
to
so
do
it's not
weekly
legally
AVOs and everything.
it's not legally required, right? In or
Some of it is, Trisha. Like you got to do weekly AVOs depending on how much volume it
yeah,
is. And I'm not the expert in our company on that. We've got people in our company that really know all those rules. But yeah, there are some legal requirements, and the EPA is coming out with some additional requirements as
right,
well. The point is, it is challenging and it is expensive, and it is cost prohibitive to meet those objectives. And the ones that are elective will be required soon by the EPA. And so and it's also a moving target. Like it's
right,
not like the regulatory bodies are saying this is exactly what you do and here's how you do it. They say you need to measure this and come up with your own calculation, right? I mean that's kind of set up for failure. I mean it's just so it's something that we take very seriously. It's something that we spend a lot of our own money in, and then like the broader goal there is like how can we sit across the table from Exxon, Chevron, Oxy, Devon, Cimarex, whoever it is, and say, hey, you should sell us these wells without them knowing that we're going to be good stewards of those wells. Because their biggest downside, and we have competitors who go and buy these wells and then completely punt on the methane or P&A liability, and that gets back to the companies. And now the company is trying to get APDs, the big companies who sell
right.
the assets, and they can't get APDs because the state land office says you sold these wells to them and they're not taking care. So we can't be like that guy. We need to
Right.
be excellent across the board in this. Otherwise, we lose our license to do more deals.
Right. But your whole business model is debunking. So your whole business model and everything you've just explained of being in New Mexico and buying production is unconventional production is debunking the it is debunking the theory that I'm a big company and I can't afford to I can't afford to do the things that are technically required and things that will be required in this completely moving roadmap on methane emissions. Um, I, you know, I think listeners know that I'm for doing the right thing always, and I think companies need to get ahead of it. I'm not for excuses, and it just feels like there's a bit of a gap there that your whole business model is saying we can do this, and that's what we're
Yeah,
doing, versus
yeah.
these companies are saying we can't. So I'm not sure that I know that they're not correct in every case. I think it's the easier thing to
For
do.
for sure. They also have teams and departments. So like, those same companies who say we can't will side with the governor of New Mexico
Right.
or the legislative on some of these anti-oil and gas bills because it's kind of anti-competition for them and they're the big muscle, right? So they'll
Right.
succeed. When a new rule gets passed like that, like I'm dealing with it, our VPs are dealing with it, our whole company is dealing with it and living with the repercussions. But I'll say this is that it used to be like Exxon, in the 80s and 90s, like they would have they would have a one line of every well they had, and at the end of every year they would tear off the bottom 10% and sell those to someone, right? Like these big companies are less inclined to sell some of these shipper well assets because um, because because of some of the lawsuits that have happened recently where if you sell it to Joe Bob and Joe Bob doesn't plug it
Right.
appropriately, it comes back to the big company. And so we've had to look at special bonds or some other stuff, and we've never been able to figure that out. But it's becoming a little more challenging that way. And so even more so, like we need to go above and beyond, and we do, so that we have the license to do more deals with these companies, right? Like
This is
we need them to know that if they sell us these wells, it's not going to end
right.
up in the New York Times.
This is why I think there needs to be a coalition in New Mexico, Colorado, and Pennsylvania. and Virginia, actually, anywhere where you have these very harsh regulatory environments and really robust oil and gas activity. I don't. We the bill in Colorado was defeated in terms of banning all new oil and gas in 2030, but there was a piece of that bill of SB. It was 12 159 or something,
Yeah.
but there was a piece of it that was on that liability, that how far back they could actually go and stretch into not
Yeah.
just the previous owner, but the previous owner. And so you get into this legal wiggle room where just no one's gonna you can't sell an asset, and that just becomes a whole messy liability. But that being said, I wasn't gonna go down this rabbit hole, but I do want to. I mean, New Mexico, I think the industry, we kind of take it for granted, but you've really pinpointed really clearly, the fact Midland versus, New Mexico. And I mean, the rock is phenomenal. The fact that we're producing almost 2 million barrels per day in Leonetti County and just
Yeah.
crushing it. And everybody's like, oh, the next month it'll go down. And no, it doesn't go down. It just
No.
keeps marching higher, which means, I mean, you see the production on these wells when they come online, and we know the gas drive, we know the profile, like it's deep, it's thermally mature, like it's killer rock. So
Yeah.
that's all happening. And it's sort of in this state that's obviously it's not Colorado, but you're painting a picture that New Mexico, it's harder to do business and there is an anti oil and gas sentiment. So, how is that shaking out in New Mexico? And I say this because hopefully given it was you that essentially helped me be able to speak there or helped the group, but it's the Independent Producers Association of New Mexico, that
Yeah.
forum that's happening in July that I'll be speaking at. Um,
Yep.
I mean, assuming we'll be talking a lot about this, but I think this is a nice precursor to get ahead of that. Is that what is it? We're talking about the regulatory environment, E&P versus production company. I don't think a lot of listeners have a really clear understanding of how hard it is or what it's like to do business in New Mexico. Um, e- the fact that we're growing this production at such a rapid rate makes it look like it's easy.
Yeah. Man, it's too early in the day for me to drink, but this is a topic that almost requires it. So yeah, like I mean, I don't know where to get started with that. I'll just say this is like at a high level, New Mexico, oil and gas contributes the lion's share of New Mexico's budget. I don't know the number, but it's something like 40%. And there is no second place. Okay, so you take that out. It's not like you got five other industries that are like neck and
Right.
neck. Get ready to fill the coffers back up. And so, but meanwhile, New Mexico it has become very blue, I guess we could say. And so there's just that, and you see it in Colorado, you see it in California. It's not unique to New Mexico. I think what makes New Mexico unique um, is that it has the best rock, the best
Right.
shale in the world. Um,
And
and so I
that's
think
enough
I
to
think
sort
there's a
of
little
push
more.
back. Is
Yeah, there's
that's
a little
enough
more
where
friction, right? I
yeah.
mean, it's like, yeah, we need this. This is
Right.
happening here. Also, I'll say this: like Colorado, the DJ Basin, incredible geologic formation,
Right.
incredible oil in place. That's in Denver, right? That's
Yeah.
in Longmont. That's in Weld County, where the
Wells
bunch of
County,
people
it's not
live.
far from Denver. Yeah.
Right? Yeah, but I mean, it's like you've got stuff everywhere where people live, right? I mean, we could go from the center of our well site where we operate and drive an hour and not see a single residence.
Yep.
Okay, this is God's country. This is where oil and gas should be produced.
Well,
The
the
lion's
reason
share of it's on
okay.
federal
Yep.
lands, and the way we produce this is the most ethical, cleanest, most ESG friendly, however you want to say it, anywhere else in the world, right? So
That's
like this is where we should be sourcing our hydrocarbons from, without a doubt.
so that's exactly what everyone says in Colorado. And I think the most interesting thing here is that, look, in Colorado, actually in Weld County, you say, well, it's near people, but Weld County, where it's produced, where, the almost 500,000 barrels per day, 480,000 barrels per day of Colorado production, over 80% of that is produced in Weld County. The people in Weld County support oil and gas production,
Yeah,
drilling activity, you name it. So, you know what? Ask the people what they think and let that be the answer, not the people in Boulder, not the people in Denver bitching and moaning, complaining about this. Now,
yeah,
now, New Mexico, I think that's what's really impressive is that, and that's why I think people have to be talking about this a little more clearly as companies, as in terms of articulating one of the benefits, all the, it's organic, it's ethically wonderful, it's natural gas, that's, it's ethically sourced, all these wonderful things about domestic oil and gas production. But I think in New Mexico, particularly, is the ability that how companies have been able to manage it, right? In Colorado, you have
yeah,
something similar where you have the big companies, Chevron and Oxy, that are able to sort of just manage and get they get chunks of permits and they're sort of living to fight another day. The little companies get screwed. It seems like in New Mexico, it's because it's so much money because Exxon and the big boys have EOG have such a presence, that it seems like behind the scenes they're able to just keep doing business. Yes, there's regulatory burdens. Yes, it's expensive, but also the wells are massive, and so you have this balance within New Mexico where probably regulators who don't love it just don't talk about it out loud. I believe my old boss used to talk about it a lot. There was a check. It was a royalty check that the state got, and I mean, it's huge, just massive from like one sale. We're talking, they're
Yeah.
getting billions of dollars in royalties, and
Yeah.
they tried to get like the lowest level of regulators because no one wanted to be on stage like taking this big check from Exxon or something, which is just it's really fascinating. So
Yeah.
I think it's something that should just be articulated and sort of embraced more. Is that like you have these places where if you push that, especially in the period that we have in the macro where you have high inflation, high electricity prices, rising energy prices. You do have serious places in Colorado, New Mexico. I was just listening to New York being a state that they can't take any more immigrants. I mean, these are all things that are happening. So this is for oil and gas to start talking about the benefits that they're providing to these states from a revenue standpoint, but also just keeping costs lower is absolutely critical.
Yeah, I think we're starting to swing the pendulum back a little bit. I mean, New Mexico's got great people. It's got a lot of natural beauty and has a ton of natural resource. Okay, and there's no reason a state like that should have one of the worst education programs,
Yeah.
right? I mean, like you guys are gifted with such resource. Let's do it together, and let's do it like we want to do it as clean as possible. We don't want to have any waste. And the small guys actually like if you ever toured our facilities and compare that to some of the large, really big public companies in our immediate area, our facilities are much cleaner because we don't have a team that can just deal with it. If we get fined, we pay that. Whereas the big companies kind of deal with it, right?
Right.
They can kind of the stripper wells look like crap and they just kind of brush it under the rug and they deal with it. And when we take them over, we clean them up,
Yep.
and we increase production. So that's our pitch to the state is like, you don't want people like us to leave and go to Texas. Because when we buy these wells, we don't drill a new well. We don't drill wells. So we just take existing steel in the ground, existing pipelines, and we increase, sometimes double the tax revenue from those molecules,
Yep. And all
right?
your effort
By
and
doubling the molecules.
it's a really great. I mean, because my dad pumped wells, and I loved it when he took over because I'd always go to the field and it was clean, right? He drug them, he
Yeah,
cleaned up the field,
yeah.
and he increased the output, and that's that touch. So if your whole business model is doing that, yeah, it's a win-win for everyone. Okay, that's great. I want to. Can we talk a little bit about given, I mean, I think there's refrac potential, in the vertical side. You haven't touched base or asked on we didn't talk about like if you're interested in vertical. I mean, we talk about stripper, but you're talking about unconventional, so it's not really stripper well production. Have you guys thought about vertical well production? That's one question. And then I want to get into given you have these wells that are older horizontal wells, are you guys thinking about refracs and future potential, or maybe is that not you guys and that's you're handing that off to somebody else and that's a long ways down the road?
Sure. So we operate 250 wells. Okay. I would say 70, this might be a clarifying point from the earlier dialogue. About 70 of those are horizontals, 70, and the rest are verticals.
Okay.
Now, I would say all of them were drilled in the last 15 years.
Okay.
So,
Right.
and so maybe, some conventional, some unconventional. It's all tight rock. It's brushy canyon, Bone Springs,
Right. It's when Pioneer
some,
was doing they were going down and fracking
yeah,
each individual one when they were
yeah,
doing
everything's
verticals.
been
Yep.
fracked.
Yep.
And so, yeah, we like vertical wells for sure. We love recompletions. Um, let's just unpack that for a second. So, um, we'll have, let's say, 60 vertical wells in a couple sections, right? And we've got a fantastic geologist who has mapped all of those, every perforation in that wellbore, okay, for all of those wells. And now we stamp that to the different formations, okay, using a really lame software called Petra. Any geologist has used Petra, come on, it can be better, but I'm waiting for someone to come up with a new software. Call me when you do. And so what we do is we now look at that as a data. We say, okay, these wells are perforated in the lower Cherry These wells are perforating the lower brushy. And if there's a gap, again, we solve for human behavior. The same way we're solving for neglect. Okay, so why in this half section did these wells not perforate the bypass pay, the upper zone, when everything else around it did? Okay, well, anyone who's worked for a large public oil company knows people that I'm about to describe. It's the completions manager that says never frack above the the base of the water or the top of the gas or the that one marker. You're never supposed to frack above that because they did that once and it screwed everything up. Okay, well, what about the other times they did that? Now is actually incredible. And so and sometimes so we'll look at that and the surrounding and say, okay, so that rock is good, and we'll map it and say, okay, that rock is good and it's there. The only reason they bypass it is because in 1992 or 1998, when you had a certain completion manager, maybe he was an Aggie, and he just decided to skip that zone. And now we go back in and we say, okay, well, the other operators in the same area or a different completions manager or a different geologist were going after that zone. And we did it. And we've seen some phenomenal results. And that's the kind of risk that, we're talking, what's phenomenal? Let's describe that. Okay, so I'll give you an average instead of cherry picking. So on average, again, recompletions, the price of that has gone up,
Yep.
huge. Like you can't do anything for 100 grand these days.
But you're talking about, I want you to keep going, but you're talking about both recompleting, so refracking a vertical zone,
Yeah,
as well as additional fracking a zone that hasn't been previously fracked.
just the latter. Just the latter.
Okay.
We're talking about going into bypass pay.
Okay.
So this is a zone that, thanks for clarifying, this is a zone that has not been fracked. It could be 1,000 feet above the producing river.
Okay.
But the surrounding wells hit that. Maybe not all of them, but enough of them, and you can kind of start to draw a correlation. And so we'll spend maybe $500,000 and go in and take a well that's making 1 barrel a day that is getting ready to be plugged. We're about to file a plugging permit, and we say, look, we think there's pay here. It's kind of in our funnel of recompletion opportunity. We'll spend $500,000. We'll refract that well and get about 100 barrels a day. Get 100 barrels a day. I mean, from an NPV standpoint, that's not as sexy as a 2-mile well, but from an IRR standpoint, that's way better. And
at
that works for
oil,
us.
Yeah.
And those are the kind of projects that actually it requires a lot of work. And the big public companies are not going to do that. And that's not anything against them because they have really high quality drilling inventory. We don't have that.
Right.
So if we want to spend $5 million to increase our production, this is what we're looking at. We can't go drill, a lateral.
But this gets to something that, and if there's foreigners listening to the podcast, and I'm sure there's at least a couple, especially thinking about unconventionals in the Middle East, I think this is a lot of people are I've spent years going abroad, going to Oxford, going to England, going to New York. I mean, everywhere you go that's further out from U.S. shale, they remove themselves from U.S. shale, right? They don't understand it.
Yeah.
And it's this piece of small companies, small operators like yourselves, especially on, you're taking, these older wells and you're bringing life to them, and not just bringing life to them for the production side, but potentially these recompletions. And it makes me think about as you think, I always thought like, okay, well, we have a great well, the EOG drilled in the partial field, and it was awesome in North Dakota, and it was 4,000 foot long, and it was the frac that they had, the completion design that they had at the time. And it was a great well then. And I don't know, I kind of grew up with a good well is a good well is a good well. So that'd be the well that I would go back into and maybe want to refrac. And so what you're doing as a company just really kind of points to, the fact that we have a lot of great existing wells, and they probably have a lot of knowledge and life left to give, left to give in from a production standpoint that really, really is probably underappreciated by just like the U.S. shale industry, but also the broader market.
Totally. I mean, this stuff has just been neglected. And the other thing that we like about it is when we compare like this zone worked, this zone was never tried, is we now have like 15 years of production data.
Yep.
Okay. Sometimes there's an offset horizontal well. You see 3 months of production data. You say, oh, I'm going to go drill a well. It's like, no, we have 15 years of time series, like what works and what doesn't work. Let's kind of talk about the business model as a whole and the opportunities that exist due to private equity, if we can. And
absolutely. No, I love the private equity side. Let's do that.
So Naturally, we're contrarians. I'd say my whole life I've been a contrarian. I'd say my partner Jeff is a contrarian. Our whole team is made of entrepreneurs. We've hired an incredible team of entrepreneurs, and we empower them to be entrepreneurs here, which is hard to do, but it's been awesome. And there's so much private equity money, less today than there was a couple of years ago. But all of that goes into the same bucket of groupthink. And everyone wants to be in the Permian. Everyone wants to be Permian minerals. Everyone wants to be Permian non-op. There's not much Permian leasehold, but if there is, that's where the private equity money is going to be. PDP is a little different because, like, you're buying this stuff at PV 15, PV 20, maybe PV 25 if you're lucky, and so that's kind of butting up to the cost of capital situation with private equity. But the point is if you're willing to look outside of the box, and you don't need to go that far. It's not like we're talking about going to, offshore Alaska here. Okay. We're talking about going to New Mexico instead of Texas, or we're talking about buying non-op in Oklahoma instead of the Permian.
Right.
The opportunity there exists because everyone's focused on the same thing. And it's easy to forget this industry is very broad and there's a lot of wells everywhere. And
a
there's
lot of companies, a lot of small
opportunity.
companies.
Totally. And there's opportunity to do something that other people are not doing without taking on a lot of risk. I have people come talk to us and say, we really like, going to trying the Codell in, Western Nebraska or something. It's okay. Like, that's a lot of risk. If you can just take a little bit less risk, you might find, just as much opportunity, such as refracting a vertical well. Private equity is not doing that. So those opportunities are there. Public companies aren't doing that. So those opportunities are there. And so if you're willing to, just take a little step to the side and kind of look at what everyone else is doing and what the private equity capital suck is forming, then there's all these opportunities on the edges that don't require that much risk. They do require capital because we're assuming that you're not going to get private equity, and I mean like institutional private equity, to go and play in that. So you've got to treat your investors right. I see a lot of private companies start out and just fleece their investors. I mean, I've looked at the returns of a lot of these private equity funds, to be honest, and the returns aren't that great. And somehow they keep raising money. That's a different topic. But like going back to the private company.
That's also, this gets to your groupthink, and I'm sorry, but like private equity, like that's their fault. And so, I know this because people are always like, "Do you work for private equity?" And I'm like, "Have you met them?" They're pretty cocky and they think they know everything. It's interesting though, because you're in Fort Worth. Dallas is a hub for. So if you're talking about private equity and that's not the place, like they're not looking at this, then we talk about what we always, in the business we call it the private money, right? It's these private family offices, which you hear a lot more about. This has been a big trend well before COVID, but certainly ripped within Texas and places like Dallas, which is known for being this private money hub, folks with money that are willing to, that understand the oil and gas market and are willing to invest in it. But the group think is still present. It's everywhere, right? I went to a lunch in Dallas, in March, and where I met you, that Adam lunch, and I met you. I did that dinner and with Covenant Royalties, but I was kind of blown away by the group think at the Adam lunch, and I'm not criticizing. It was just like I haven't been. It was a room full of 200 young men that were very intelligent, but they were all sort of had a very bullish thesis on nat gas but kind of uncomfortable and didn't on the strip and everything. And so it was very interesting that I obviously need to spend more time with some folks in Dallas, but there did seem to be a pretty big group think. And I thought that's whether you're in, I think that's because you got so many folks in the business. So is that different than, the private money is yet?
Yeah, yes, those are all great observations. I love Nape. Like Nape is my I'm not going to call it my happy place, but I like Nape a lot. But like, man, I go down there and it's like, man, everyone looks the same, and I'm sure I look like that too. That's fine, but like everyone's talking about the same thing, and it just like picture that and then figure out how you can do something a little bit different. And there's opportunity there, but you got to be able to raise the money. So maybe for listeners, it would help to kind of explain a little bit how we raise money.
Yeah.
I'm a big believer that, with a good deal, there's always money. Okay. But you got to have a good deal. And so we had a good deal and we raised money from 32 private investors. We can call them high net worth, we can call them family offices. Almost all of them had oil and gas experience. Some of them were operators. Some of them might be oil and gas private equity founders or private equity managers, but we didn't take private equity fund. So just them personally. Some of them might be oil and gas hedge fund guys with oil and gas backgrounds, with oil and gas kind of expertise on the public side. So we took money from 32 people, me and my partner Jeff, and employee number one, our VP of operations, Justin Warren. The three of us put in a substantial amount of our own money. So we were coming in for about 20% of the pie. You don't see that often. People try and get away with putting 2% of the money. Personally, I think that's chicken shit. But
Well, you got
that's
to have the
that's
money to be able to do it. So there's
for
a
sure. It's also the scale. It's also the
right,
scale. Our first deal was small, so we were able to do
right.
that. Um, but sorry, that was just my opinion.
No, that's fine. That's fine.
And then we used no debt originally, and then as we grew our company, and we got really lucky with timing. But as we grew our company, we then started getting banking relationships. I had no banking relationships. Jeff had a couple. It had been a while, and so together we really didn't have a Rolodex of. And when I talk about bankers, I mean lenders. And so we kind of worked with a couple different banks, ended up with Amarillo National Bank, and they've been fantastic. And I think and I just kind of want to make sure, like this is a point that we really feel is important at Buckhorn, and it goes for any of our partners, whether they're vendors or bankers, and or M&A advisory guys. Like you've got oil and gas operators are so used to being, I'll just use the word entitled, where everyone's taking them to play golf, everyone's
I'm
taking them
shocked.
to lunch, everyone's doing this, and they just, especially like drilling engineers, right? I mean, go to any free sporting event they want. It's like my friend Clay Gaspar, who was a great mentor at WPX at the time, now Devin. I remember one time oil price crashed, and he got us all in a room. He said, "Now is the time to take your vendors out to play golf, take your vendors out to lunch." And that's always stuck with me. And whether oil price is high or low, that's what we do. I mean, we don't
Yep.
always take them out to lunch, but we treat them with respect,
Yep.
and especially your lenders. I don't know why, but so many private oil and gas companies, private equity companies, um, treat their lenders like they're disposable. And wake up, there's not that many lenders left.
No.
And
And
even if there are others to go to, like why are you running your business like that? Why are you ring fencing it and just kind of leveraging it up? And then like if you screw your banker, you'll be fine. I mean, that's different ways to skin the cat, but that's not what we do. And so I just think that operators need to have a little more humility and treat their vendors, treat their bankers, treat their M&A guys. Like you don't just sit back and wait for them to do something for you. You got to do something for them. You got to be proactive.
I
So I think that's a big thing that the industry misses on.
That's a really great commentary, and I know we want to wrap this up, so we're definitely going to have you back on the podcast to literally just talk about the macro, and we can go back
Yeah,
and forth on that. But I think two things I want to talk about before we close, and that's so you talk about the money and the access to this money and access to capital, and I think that's crucial. And I think we often forget that just because a lot of people have money, and this does get to the macro, just because there is money out there, it's actually harder to like you have to have the good deal, right? You have to give people a reason to invest in this. And it's where I have been very critical of private equity. I'm still it blows my mind that people hedged at $26 oil, and that even now I could get them on the podcast and they will defend it and say, well, we had to. No, they didn't. It's called of a lack of intelligence in so
yeah,
many faculties there, so many pieces. So I think that, and I really do, and I say this a lot, I think it's really, really important to have, you have very thoughtful leadership, and you look at the market, you look at things holistically, and you have to care about people, and you understand the human element to this business. And I think that's really, really important, because we do have groupthink, and I do think we have a lot of poor leadership in this space. And look, like if I know where I spend time on the macro, I spend time on the policy side, I spend time on the individual well side, and you have to have good leadership that's willing to stand up to the BS that's happening in Washington. And we have not had that. We're barely
Yeah.
starting to see that right now. And the fact that we
Well,
haven't,
yeah.
and yet we have the moral high ground, is really important. And this is why I say this to my clients, but every private company is like, you have a role too. Private companies collectively make up so much production in this country, and also are just like have so much staying power and bring so many jobs and have such a role in their, in their communities, and helping people and creating jobs and creating wealth. And I mean, the direct and indirect benefits are just huge. So I can't underscore enough how important it is, the stuff that you're doing, and how that trickle impact, and paying attention to where you're getting your money, and paying attention to your lenders, and taking care of your vendors, and making sure the rising tide lifts all boats. And if you've grown up around this business, it's a boom and bust business. So
Yeah.
yes, oil prices are good now, and I'm a little bit anxious because I feel like everybody feels that oil prices are never going to go down. They will go down, folks. Hate to break it to you, but you're not going to like, they can go up, absolutely, but they will come down, and they just won't be
Yeah.
high forever. Um, I mean, that's just a piece of it. But you talked about COVID, you talked about your, how you guys started the company, your role in this, and I know you want to talk about, like, giving a shout out to people pushing on the entrepreneur side. I mean, as you were explaining the COVID thing, I was thinking the same thing. I was just thinking about, how COVID, it was hard for all of us, especially in the oil and gas space. And either you doubled down, as I did on my business, and lost my job with Anschutz, and doubled down on Petronerds, and just literally, I don't know that many people in the oil and gas space that actually made money in 2020. Most of us lost a significant amount of money. But that thing is that, all those hard times, you have to push through them, or otherwise that's why 60% of businesses fail within the first year. And so that entrepreneurial drive, you sort of have to stick with it. So I mean, you talked about, you're a recovering geologist. I mean, you're obviously a CEO of this company, Buckhorn, which I love the name Buckhorn, by the way. um
Thanks.
but what would you say for folks that are on the fence right now, of like, wanting to step out and, have lived this lovely space with a nice paycheck, and they work for an oil company, but they also understand the macro, and they hear this ESG pressures, energy transition, everything. They hear the noise, and they're just kind of uncertain, and they still love the oil and gas space, stepping out, doing something new. What's your advice to them?
Yeah. Yeah, it's close to the heart, so I got a lot, but I'll try and keep it short. I would say you gotta be able to access capital. You don't have to have your own capital, but you gotta have
Yep.
someone who's willing to back you, and be prepared to put everything you have on the line, not only emotionally, but financially as well. I think it won't always go as quickly as you'd like, so be patient. Timing is important. Rather be lucky than good. And then the biggest thing, and we've got a couple younger guys that work for us, and I always try and um, promote this and push them, is kind of, I guess I'd categorize it by getting outside your comfort zone, but really what it comes down to is like networking. You know, if you're a geologist, if you're a 1 or 2 year geologist out of school, spend more time with the drilling engineers and the landmen at your company. Like, sure, go to the core workshops. It depends what you want to be. If you want to be like, like a super sharp core rock analyzer, then go deeper there. But like, if you can get some broad experience, not only with knowledge but also network, one day you might need a drilling engineer. And if all you do is go to lunch with geologists, you're never going to meet the drilling engineer. He's never going to like you because you're a geologist. And so like and then get in the flow, like get in the deal flow. Go to the conferences, go to the conference happy hour, go talk to someone that you don't know there. Don't just talk to everyone that is talking about the same stuff you're talking about, that has the same background you have. Go to that guy who you don't know and go talk to him. You never know where that's going to come. And if you want to have a 30-year, 40-year career in this business, plan for it, because you never know when that guy's going to come back around. Maybe he wants to be an investor. Maybe he's going to help you do a deal. Maybe he's going to help you find a deal. And so a lot of the old time guys in Houston, you see all those same people at all the same conferences, and that's what they're doing. I mean, they're going to those things and building the network, and the network is so important. And again, it's not just your silo discipline network. It's people outside, people who you don't know what they do. Go figure out what they do, because they might be just as interested to figure out what you do. And then lastly, find people that you can ask stupid questions to. Like like what I know now is very different than what I knew 3 years ago when I started this. I was a geologist. I didn't have a banker. Like the whole thing was brand new. And what I know 3 years from now is going to be very different than what I know today. And so, like, if you have a network of mentors that genuinely care about you, that are really smart, and you can ask them dumb questions, then you'll be prepared to sound smart when it matters, right? And so if you're negotiating an RBL with the bank, make sure you have a couple friends who might be CFOs who have done that before that you can call at 10 p.m. and ask them questions and have them support you and have them look at your red lines. And then so that when you go give your turn back to the bank or to the lawyer or whoever it is, you kind of have your stuff together, because you can't be expected to know everything. There's no way. So don't
No,
act like that.
there's a business that does that. It's called Petronerds. That
Exactly. And let's talk
yeah.
about Petronerds for a second. So, Trisha, when I met you at that Covenant Royalty, love those guys. Uh, I was immediately, interested in what you're doing because the business needs more advocacy. Okay, and you know your stuff. You have the background. You grew up with it, but you're very well educated in the topics you discuss, and you've got the energy level. And you and I could talk at 100 miles per hour for 5 hours. I don't think the listeners would lose their attention. But I love amplifying your voice however we can. I'm pumped that you're coming to IPA&M. I think it's gonna be great for all the New Mexico people there. Just the business needs more people like you. A lot of people in my position can only say so much or do so much. Not They don't even know the facts, but sometimes they're worried about having too loud of a voice because then they get a target on their back. And so, like, having people like you, who are kind of third party and know the stuff and have the relationships with Washington and Austin and Santa Fe, and just kind of have your ducks in a row, I think is super important for the industry of companies all size. So thanks for doing
Well,
what you do.
absolutely. No, I appreciate that a lot, really. And I mean, the advice you're given and talking to people about this is like, I think it's, I've self-taught myself enough production and geology and engineering to sort of learn things. And I would say that it doesn't matter what sector you're in the business, but your advice is fantastic. Is like learn the business, ask hard questions, ask stupid questions, be kind to people. And, I always learned growing up around the business too, is that it is a boom and bust cycle. So you save the money now, for the rainy day. I mean, you save it for when you need it, when things are good. And also, another advice my dad said is you don't, don't step on the toes for the ass you're going to have to kiss tomorrow.
Yeah,
So you don't want to burn any bridges. And I think that it's interesting because there aren't that many young people. We're roughly the same age and under 40, and there are not that many younger people in this space anymore. There are, but not as many. Like a lot of people have left, and they're working in energy transition or ESG. You want to know where all the women are in the space? They are working for oil companies on ESG, which I think is kind of
yeah,
BS. But anyways,
yeah.
I really appreciate that. It's been an absolute pleasure to have you, Sam. Like truly great, really fun, and we will certainly. I will have you back for a just we can shoot the shit on the macro.
Awesome. And if anyone, any listeners out there have any questions about how we started or want to kind of anything I can do to support your own entrepreneurial goals, please reach out. You can find me on LinkedIn or however you can find me. I'm easy to find.
Awesome. Well, thank you, Sam.
All
Bye.
right. Thank you so much, Trisha.
All right. Bye, folks.
Bye.